Hi there. Welcome to Pivot to Prosperity. Today we have Ben Fraser as a guest, and I am going to read his bio first. And welcome, Ben. Thank you for joining us. Mr. Fraser is the Chief Investment Officer at Aspen Funds. It's a 5,000 company, an Inc. 5,000 company, and is responsible for sourcing, vetting, and capital formation of investments. Mr. Fraser has prior experience as a commercial banker and underwriter, as well as working in boutique asset management. Ben is a contributor on the Forbes Finance Council. He's also a co-host of the Invest Like a Billionaire podcast. And that's a really fun podcast. I appreciate you coming on, Ben. Thank you.
Yeah, thanks so much for having me.
Yes. Well, so we were talking a little before coming on, and you have an interesting journey. Yours makes more sense than a lot of people's, but would you go ahead and just give us a little overview?
Yeah, sure. So I started out my career really working in kind of boutique asset management and saw just kind of the inner workings of a very large, successful asset management firm that actually dealt in alternatives and worked with kind of large institutional investors, like big endowments, pension funds, et cetera. And then kind of jumped over to commercial banking. So I was a commercial banker and underwriter for many years and learned a lot about how to underwrite investments, underwrite deals, and really kind of peel back the layers. And one of the really fascinating things that I saw from doing that, as you know, one of the benefits and one thing I loved about it is you're looking at these deals, you're actually getting to look at the personal financial statements of, you know, the wealthiest clients of the bank and can see right under the hood of what exactly are they doing, how do they make their money. And what really kind of stood out to me was there was a pretty common theme among most of these, you know, wealthy clients of the bank, and it was, you know, two things. One, they were either a business owner or had invested in real estate and were doing that actively. And so to me, it kind of put this light bulb moment, right, of, you know, wanting to grow my own wealth and wanted to follow the patterns of successful people. And so decided to kind of go onto the equity side of things. So joined Aspen Funds about 6 years ago, and really now lead the charge for all of our investment opportunities, sourcing the deals, underwriting them, raising the capital, et cetera.
Oh, that's great. And now you have a brother as a partner, correct?
Actually, my father. So
it's
yeah.
Your father. Oh, okay. Right. and so he was already into that line of work. Is that right?
Yeah. So he started the company with another partner 10 years ago. And so I joined them about 5 or 6 years ago. And yeah,
that's nice. So you had it in your blood.
I did. Yeah, it's interesting because I never necessarily planned on joining them, was having a successful career, but really the opportunities kind of just aligned and it made a lot of sense. And looking back, I'm very glad, and it's been a really fun ride and a great experience.
And y'all have grown tremendously, I believe, right? Over the last 10 years.
We have, yeah. We 10x the first year, or the first 5 years. We 10x the second 5 years, and we're looking to 10x again. So it gets harder and harder the bigger the numbers get, but it's a goal.
And your main assets? Why don't you go ahead into that?
Yeah. So Aspen Funds, we started really 10 years ago as an opportunistic kind of investment firm. And really when my father and his partner started it, was not really thinking long-term of building a legacy firm, but building just a unique opportunity around distressed mortgages, which at the time, there was a lot of those, right, coming out of the 2008 crisis. And, you know, first did a friends and family fund that they raised for and had some great success with that. And to continue to scale, continue to reinvest back into the business. And, you know, fast forward 10 years, we've raised about $150 million in equity from kind of accredited investors. We manage probably at least 10 different funds, and continue to grow. We've expanded our assets that we invest in to a lot more than just distressed debt. We've invested in multifamily, self-storage, industrial, retail, as well as oil and gas. And so our approach is a little bit different than a lot of syndication firms or firms that are raising equity, in that we call ourselves kind of asset class agnostic. And what we mean by that is we're more opportunistic than focused on a single asset class. So a lot of syndicators will focus on just say multifamily, for example, and there's some benefits to doing that. But what we've found and what we really believe is that following kind of the macro trends is a more important strategy for successful investing than it is gaining marginal efficiencies from, say, vertical integration or focusing on a single asset class. And we're seeing that right now, right? As interest rates are higher, commercial real estate has some headwinds. It's harder to find certain deals, and the deals that worked a couple of years ago, those strategies are not working as well. And so, really to harken back to my father's prior experience, even before Aspen, he ran a tech company back in the late 90s, and really learned this lesson the hard way, where in the late 90s, anything with a .com behind it just was a rocket ship. And so he had raised 44 million in venture capital, was one of the fastest growing firms in the Midwest. He won the Ernst & Young Entrepreneur of the Year award, and just headed for the stars, about to go IPO. And then the tech wreck happened. The tech bubble burst, and all of a sudden, anything with a .com behind it, was now not even worth thinking about or looking at. And so he ended up losing that business, and it really taught the lesson of timing really matters. Because back then in 2001, you could buy Amazon for shares for a couple bucks, right? And so timing's a big deal, and we've kind of used that approach into our strategies now for how we invest in finding what we call the economic tides, so the macroeconomic trends, and positioning ourselves as investors in those trends creates a lot more tailwinds, a lot more margin, and ultimately we think a lot more success in investing.
Well, that's great. And it's funny, one of my guests next week is a professor that teaches and also works in a company I used to work at that tracks all the economic tides and does feasibility studies. It's a great thing. I have to ask you then, following the mega trends, what do you have as your trigger or fail safe for when the tide is turning? How do you see that coming?
Yeah, so I think one of the things that's important to distinguish between, tides and waves is kind of a metaphor that we use. So a lot of times it's difficult to predict the waves, right? Or the kind of ups and downs, the roller coaster, say the stock market or other things that are going to be more sentiment driven. But the tides, you can generally have a good sense of directionally where things are going. And a lot of times we want to anchor ourselves to tides that we think have a long runway. And for example, like in multifamily, we're still bullish on multifamily as an asset class. There's still a lot of demand and need for housing, but a lot of the the deals that were being done a couple of years ago, they're just not working now because they were bought with aggressive cap rates, with floating rate debt at very high leverage points. And a lot of those deals we're starting to see the beginnings of potentially unravel. And I think that's going to put some pressure on the market. But we actually are still doing multifamily. We're actually shifting more to a development focus. And I can get into reasons why we like development right now. But again, the asset class as a whole we like, but the strategies within the asset class are kind of shifting, if that makes sense. And to more specifically answer the question, as things shift, we always underwrite to at least, several different exit strategies and plan Bs, plan Cs on every asset. So we know we have multiple exit strategies and abilities to hold assets for the long haul. And so a lot of that comes down to the debt that you have on a property. So I'm very, very focused on the debt side of the equation, because especially right now with inflation where it's at and where I think it's going to continue to be is at a higher rate, that's a very big boon to asset prices over the long haul, because that's going to drive net operating income growth, which is going to drive value growth and pretty much all commercial real estate. So the biggest question and challenge then is, are you able to hold on to the asset through the turbulence, right? Are you able to manage through it? And that's what we're focused on right now. And all of our assets, thankfully, are performing very well.
That's good. That is. And that goes into a couple other things we were touching on before connecting on the recording. And I think the meetings we go to and the people we track and spend so many hours following helps to know if the tides are starting to change. But the capital stack, like you say, the way you get into a property to begin with is vital. So what kind of what kind of capital stack are you doing usually?
Yeah, I mean, every deal is different, and I think it has to depend on the strategy. I've never been a big proponent of bridge debt for commercial real estate. We've never done a deal with bridge financing. And for those that are maybe unfamiliar with what it is, this was one of the largest kind of capital providers over the past several years to commercial real estate, and especially multifamily. So what these lenders would do is they would lend to, say Class B, Class C value add deals at 80%, loan to cost, and then they would fund 100% of the renovations. So your effective leverage is going up to say 85% or more, and they're generally were being bought with very aggressive cap rates, meaning very high prices and pretty big business plans that need to be achieved. And then the benefit and the reason why a lot of sponsors liked these types of capital was it was generally going to be non-recourse, meaning the principals did not have to sign on the loan. If it went bad, they would not have recourse personally. But the trade-off for that is they were generally going to be fixed rate loans. And so that was a risk that I was never willing to take on any of the deals that we've done over the past several years. And, that's a bet that some sponsors made. And I think to their detriment right now, as we're seeing interest rates going way higher, that creates a lot of challenges. And so, I think that the capital stack, you have to, coming from my banking background, what you really are trained to do is you look at every investment, every deal, and you break it down to its most simple form and ask the questions, or what are the key risks and what are the risks that I'm taking? What's the probability of that risk to happen, and what am I doing to mitigate it, right? So it's all the kind of downside scenario analysis, but it's very important, and it's very important to quantify what types of risks are you taking in a particular deal. So a development deal is going to have a different set of risks than maybe a value add rehab project, for example. And so differentiating between those types of investments and the risks will help inform the capital stack. But generally speaking, I don't like anything with floating rate debt. I don't think that's, especially right now, I've been hearing some sponsors that are, willing to take floating rate debt on their properties because they believe the probabilities that rates go back down from this point is higher than them going up. And while that may be true, that's still, again, something that personally I just am not comfortable with. And I would rather have a deal that I can sustain, and make work at today's current interest rates, and maybe give up a little bit on the back end of rates going down and refinancing into a better rate. But that's again just not something I'm personally comfortable with, and I think you have to understand as you're getting into certain deals.
So do you have a certain target loan to value?
Yeah, again, every deal is different. Like on development right now, we're seeing leverage rates go down a decent amount. So we were at 70% on the latest deal that we did in January. Right now, the next deal we're looking at is probably going to be about 64 to 65% loan to value. So equity is, more equity is being required for every deal, as the banks get a little bit more tightening in their credit and the types of deals that they're doing. And so I think it's kind of what we're seeing on that. On existing asset purchases, are probably in that 65 to 70% range.
So I don't think you'd probably know. I was an appraiser in the 80s. So during the savings and loan crisis, I was going in and looking at a lot of developments that would belly up largely because the banks closed. They weren't all problematic. Infrastructure may be in some of the buildings, usually residential projects, not all, some others too, but so we'd have to estimate the value as is and then as complete. So I had PTSD from that for the longest time. And now after having my eyes open to syndications and getting entrenched with the local national apartment association, I've been involved with legislators and pushing certain legislation in Florida. And I'm actually to a point where I will look at new construction. It's been a long, hard road. And so I've been talking to some of our people in our mastermind about that. But I'm with you. That bridge debt's very tricky. I wouldn't use it in most instances. And the 65, 70%, I think, that's a good rule of thumb always, really, in many respects. It just gives better returns in the end if you can do it. I know a lot of the people today never saw downturns. I've been through a few since I've been in real estate since 83, I'm with you. And you've seen it front row with being in underwriting. And so what kinds of assumptions? Okay, let's build a little scenario a little bit for you. Let's say, well, are you bullish on new construction or can we talk multifamily maybe instead, existing value add?
Yeah, absolutely. So
okay.
what I'll make one comment to what you just said, because I think this is one of the challenges that we're seeing from investors and what the expectations are. And when you have lower leverage, your actual projected returns usually are lower, right? Because the more kind of leverage you have, it can be an amplifier to the equity returns, especially if your debt is cheaper. And I think what we're seeing right now is as leverage is coming down, the projected returns on deals are going down. But to your point, lower leverage generally means lower risk as well, especially as you're kind of going into maybe a little bit of a credit tightening cycle, And so I just want to make a comment there, because I do think investors do need to kind of readjust expectations on,
you're right.
what's the return I'm getting for the risk that I'm taking, because there's still sponsors out there that are through a combination of getting debt and getting potentially pref equity or mezz debt. They can get a much higher effective leverage, but they're paying a lot for it, and it makes the deal a lot more risky. So you can get to that 17, 18, 19% IRR, but I would say you're taking a lot more risk to achieve that, especially on a value add project is what I'm talking about, than you were even a year or two ago. So what we're seeing on multifamily, to kind of comment on that sector, is what I've kind of called an inversion of the risk curve, right? So we've heard of the inversion of the yield curve.
Yeah.
And what I'm kind of seeing, and it feels kind of contrary to just intuition, but in certain instances, I actually think development opportunities are taking on are having less risk than a value add opportunity. And let me explain why I think that. And again, there's a lot of caveats. There's a lot of nuance to what type of product are you building? What's your basis? What's the market? What market are you in? What's the new construction starts? What are the new deliveries happening? So there's a lot of the market analysis. And so this is assuming that there's a need for it, that there's demand for it, that there's strong occupancy, and there's not about to be a ton of completions. in your market, which we are finding, right? In several markets, especially in the Sun Belt, there's been a lot of development. And I think that's going to create some softness of demand. But the point is, I'm comparing, a development project to a value add project, right? So you're taking more risk anyway. In value add, generally, you're going and buying an older vintage property. You're assessing the market and making the case for why these rents are below market, and if you can increase the value of the unit by making it look nicer and increase the rents, then you can increase the value of the property. And that strategy has been an age-old strategy. It works well in a lot of asset classes. But what I saw and what we saw as kind of a broader market sentiment is that those deals got priced very aggressively. And so Class C assets were trading at, much, much lower cap rates than they historically have traded at. Class B assets, the same. And, whenever you're getting that kind of price appreciation, that price per door on these older vintage assets, you're creating the kind of the bar to be much higher, where you have to hit, and you're taking on more risks to do so, and generally have to purchase with higher debt. So as a comparison, development, you're generally you're building in generally nicer areas. You're building a much newer product that's going to attract more tenants because of the amenities package, just it being new. And from a investor standpoint, on value add projects, at least the ones we've done, we generally have done heavy value adds to where there is no cash flow for like 2 years anyway. Wow. On a development deal, that's usually kind of the time frame before you start seeing the lease up, at least on the first phase of a project. And so you kind of take away some of that kind of cash flow risk because it's pretty comparable to value add. Then you look at development risk. So construction costs are a big concern, but right now, because the market has stabilized quite a bit, you can get we're getting guaranteed max contracts from very reputable construction firms and developers in our market here in Kansas City, because they have a high level of confidence of what they can build these for over the next 24 months, or a higher level of confidence, I should say, than during COVID. And so we're basically removing the construction cost risk from the equation, right? And then what I've found too is that in development projects, because you are taking a little more risk, there's generally a lot more conservatism kind of built into a deal to make it work. And you want to be sure you have a lot more levers that you can pull if needed. And so there's generally what I found to be a lot more potential upside in a development deal, than a value add deal. And then on the exit side of things, I think what we're still seeing, we haven't seen a lot of reversion of cap rates. We haven't seen the prices of kind of Class C, Class B assets come down a whole lot. And so right now, if you can kind of compare apples to apples, I think the risk that you're taking based on the returns that you could potentially hit, development in my mind, and again, certain instances and the big caveats in the market, but can be a potentially better risk-adjusted return. You're generally going to require higher returns, right? We don't underwrite anything less than a 20% IRR on a development deal, and so there's a lot of comparisons and reasons that we like that better right now.
Well, yeah, no, I hear you, and it's so location. It really that's key, and the demographics. Those are the drivers, not just the population demographics, but the economic drivers, that's huge. But I hear you. And going back just for a moment though, on the multifamily thing, and I get it, what you're saying is, with the lower leverage, you get lower cash flow and returns, but that's until the end. You get a bigger pop at the end, wouldn't you say? That when you average it out, because you ended up paying overall less debt out?
I mean, not necessarily, because, it's all about your cost of capital. So equity is going to be always more expensive than debt. So if you have less debt, you may have a bigger return a profit to the equity investors, but you had more equity in. So at the end of the day, it's generally going to be a lower overall return, all things equal. But
Less
in
risk.
the case, but there's much less risk. So if the deal doesn't perform as well, or you don't sell for the cap rate that you thought, or cap rates expand by 100 basis points or 200 basis points, a lot of these deals that are highly leveraged, that's actually a complete equity wipe, right? So if you're, if your deal was levered at 80 or 85% and the prices go down by 15 or 20%, that means all the equity in the deal is gone, right? But if you're leveraged at 65, 70%, it goes down 15%. Well, in that scenario, you've only lost half of your equity versus 100% of your equity. So that's where, it cuts both ways. So
Yeah.
If everything goes well, then the higher leverage deal is going to perform better. But if everything doesn't go well, the higher leverage deal is going to get hit the hardest.
So that's a great segue into the macro trends in some respects, because, those all influence kind of the overall environment and kind of where money runs in some respects, perhaps too. So why don't you touch on the macro trends that y'all are specifically really excited about right now? I've seen some of your newsletters and whatnot. I'd like to give a moment for that.
Yeah, well, thanks. We follow quite a few trends. I'll kind of mention a couple of them, and to be clear, these aren't exhaustive. These are just ones that we're paying attention to that we think are interesting and also present opportunities for investors. And so that's really what we're looking for, is the intersection of a trend that's long term that is presenting opportunities. So, first and foremost, we have a lot of analysis on our podcast, the Investing a Billionaire podcast, that we've done on inflation. And, we are of the camp that believes inflation is going to be sticky. It's going to be here and going to be higher than likely the Fed will prefer for a period of time. And I think there's a lot of reasons for that. The simplest ones are, one, it's going to be labor shortage. We're still seeing a massive labor shortage, even post COVID. It's only gotten more acute, and there's been a lot of pressure on wage growth, wage inflation. We're seeing that slow down a little bit potentially, but it's still, the numbers that just came out just recently from the Bureau of Labor are just shocking, right? The unemployment rates that we have right now. And I don't think that's going to dramatically change anytime soon. We're looking at the other kind of core component of CPI is energy. And while energy prices have been a little bit lower over the past 6 months or so, one of our big issues here, which I'll get to, is that we think energy is going to be expensive for the next decade. That is fossil fuels and probably all energy, but that's a big driver of CPI and bringing back a lot of industry and warehousing to the U.S. And for the past several decades, globalization has really been the key trend, but now we're kind of seeing a reversal of that since COVID, right? With all the supply chain issues, all these companies that are kind of redoing the calculus and thinking, it's not worth the risk to not be able to sell our Ford trucks because we can't get a simple computer chip to put in and be able to sell this. And I think Ford, for example, has $5 billion worth of inventory just sitting in parking lots that they can't sell because they don't have all the chips they need and they can't get them fast enough. And so a lot of these companies are shifting kind of their approach and are planning on bringing manufacturing back to the U.S. As well as bringing back more inventory to store in warehouses, and to be able to have access to critical components and not rely on kind of the just-in-time inventory system that was, the key marker of the past few decades. So that's going to be inflationary. So all to say, we think inflation is going to be higher for longer. So how does that impact our investing? It's possible that interest rates are going to be higher for longer, and it's possible that we may not see the same low interest rates that we saw, the past few years for a while, if ever. So, I think things have changed a little bit. regarding that. So that has to kind of impact, the bets you're making as an investor on, do you think your interest rates are going up or down? And if inflation stays high, I think unless they cause a massive recession, they're going to be pressed to keep interest rates higher. And then the kind of last trend that I kind of alluded to, it was energy and oil and gas. And so what we've been seeing, we've been investing in this asset class for several years, and are pretty bullish on oil prices over the next 10 years, because what we're seeing is a really pretty simple, supply and demand challenge going on here. So over the past really 7 years, since 2015, there's been a 50% reduction of investment back into new production domestically for new oil and gas. And you say, okay, well, why is that a problem? Well, if you think about oil and gas, it's the mother of all commodities. It's in everything that we do in America, right? It's not just for transportation or for fuel, but it's in plastics. It's for everything. And just because it's a depleting resource, right? It's different than real estate that generally appreciates. Oil and gas is a depreciating resource because you're pulling it out of the ground and you're not replacing it. And so every year, 5 to 7% of the production that we have disappears. And so by nature of the asset, you have to be drilling into new production to replace that. Well, that's dropped by half. And part of it has been driven by the ESG narrative of, trying to get to renewables faster. And so a lot of the politicians and the incentives have, disincentivized investment into fossil fuels. And they're trying to force the hand of the renewables to make it happen faster. But the challenge is just the timelines they've set are just very unrealistic. And so you have this kind of decreasing supply curve. It's very difficult to just turn on a lot more supply. And then demand is actually projected to increase over the next 10 years because of this, right? Because we can't just flip a switch and convert to renewable energy overnight. And I think it's going to be a lot longer than 10 years that demand still stays high. And so you kind of have this, simple economics. It is, if you have decreasing supply, you have increasing demand, and it's inelastic supply, meaning you can't just turn on more supply. That's going to send prices one direction, which is up. So that's why we're excited about it. And then from the market itself, there's just been a lot of, because of the lack of investment, a lot of these big private equity firms are getting heat for not investing in the ESG type deals. And so there's a lot of money that's kind of left the market and creating a great opportunity for those that can go in these middle market kind of opportunities.
Yeah, I totally agree. We can't just switch midstream, and oil and gas have to be around for a while. I like those as an asset class as well. But I do think AI can change a lot of the labor picture potentially, and some other things that's kind of the wild card. And like we were also talking about before coming on, I'm wanting to bone up more on data centers. I think that there's going to be vastly increasing demand there. So I'll be looking at that, but I totally think that your newsletters and your trending is good, and I love that we're bringing back industry to America. I think that that's really a smart play. I always enjoyed appraising industrial warehouses for just that reason too. I think it's the backbone of America, So
yeah,
that's
totally.
an asset class I like. Yeah. And mixed use.
Well, that's what we're doing. A lot of industrial deals right now too. That's the other asset class that I alluded to that we're interested in because of the reshoring. But we're doing industrial development deals right now. Actually, I mean, nationally, the vacancy rates are at all-time lows.
Yeah,
and there's just a massive amount of demand. There was $1 trillion that was spent in reshoring initiatives just last year, and this is the beginning of a massive shift of the tide to bringing industry and bringing inventory back to the U.S.
Well, we should talk more. I know you have a hard stop, so I'm going to go ahead and stop us here. Why don't you tell people how they can get in touch with you and follow you?
Yeah, though the easiest way, if they like podcasts, they can check out our podcast, Invest Like a Billionaire. Or you can check out our private equity firm, Aspen Funds, which is aspenfunds.us.
Yeah, that .us is different.
Yep.
Yeah.
Yep.
Okay. Okay. If they want to reach you, just Ben Fraser at.
I'm hard to reach, but if you click on the get started or reach out to our team, someone from our team will definitely be available.
Okay. All right. Fair enough. Well, thank you so much. I'm sure we could do this a lot longer, but I don't want to mess up your timing there.
Yeah.
Thank you.
No, thanks so much. This is great.